Dow plunged nearly 800 points today, despite the Fed cutting rates. And many stocks in the oil space have been bearing the brunt of the recent volatility. On the last day of January, after Exxon and Chevron both reported solid results and their stocks still got clobbered, I said something controversial. I told you I was done with the fossil fuel stocks. Like Larry David's friend in the most recent Curb Your Enthusiasm, I couldn't take the disappointment anymore. Between Wall Street suddenly growing unconscious about the environment and the price of crude continuing to get hammered, that's been a pretty darn good call. I am still leery of the oil patch, and I sense a budding move toward endowment divestment. But, and this big but, I am always willing to listen to the other side of the story when someone disagrees with one of my theses. Earlier today, we had a chance to check in with Mike Wirth. He's the chairman and CEO of Chevron for his big analyst day event in New York City. Take a look. All right, Mike, you got to explain something to me. Best balance sheet, best dividend policy, best growth, best total return, and yet your stock is having a problem. If you were in any other industry, Mike, I would say that you'd be one of the best performers. Explain what's going on.
Well, right now, I think the psychology of the market has been a challenge in the short term because of the coronavirus. Right. Longer term, I think there's been questions about energy transition, which we welcome. We welcome the future. We intend to be a big player in the future. We're taking care of all the right things, and we're built for an environment like this with uncertainty.
Now, when I look at your buyback, for instance, I say, what are they doing buying back so much stock? Don't they understand it doesn't matter that these portfolio managers don't care? I look at the dividend. Wait, do people not trust the dividend with all that cash flow? You paid it all out last year and you still finished with a better balance sheet.
Last year, we were the only company in our industry for the last 2 years, as a matter of fact, to raise our dividend, fund our capital program, buy back shares, grow production, and reduce debt. Our future is strong, and we're delivering for investors, and I believe investors will see that and will be rewarded.
But when? Since 2014, look, because of your great dividend, you had some return, but frankly, it's minus 1%, best in the industry. But it's when people do not want to own oils.
Well, in 2014, oil prices were over $100, Jim, and today oil prices are below $50. So we've seen a dramatic drop in the price of the commodity. We've reset our cost structure, and today we're telling investors about further improvements we'll make in our cost structure, our margin capture, and our returns. And over the next 5 years, we intend to double free cash flow per share, which gives us the capacity to fund $75 to $80 billion in shareholder distributions over just 5 years. That's nearly half of our market capitalization back to shareholders over just 5 years.
All right, so let's posit this. Is it possible that there is what I call an ETFization, that oil stocks trade the same, even though some have superior characteristics to others?
I think the market is discerning. And the ETF phenomenon is certainly changed active investing over the last decade or so. But we're meeting with investors today who do make choices, and I do talk to people that understand the difference. And over time, I still think the fundamentals and quality will show through.
Why not wait with a buyback and see who goes under? Look, there's a company that bought an asset that you actually competed for. I look at that balance sheet, it's stretched. Yet it's still regarded as one of the better balance sheets. I'm talking about Oxy. Why not keep your powder dry and be able to buy a lot of companies that you and I both know are going to be in Chapter 11?
Well, we've got the strongest balance sheet in the industry, and we're buying back shares. So we've got the cash generating capacity to do both. When I talk to investors about share buybacks, they say, we don't like them because we think companies only buy back when the price is high, when you're doing well. We've committed to buy back through the cycle. We're certainly in a down cycle now. We intend to see that through because we've got the best financial capacity in the industry. We've got a low dividend break even, strong balance sheet, and strong cash flow coming out of our portfolio.
Right, let's talk about ESG. When I look at flaring, which to me is the single worst thing that oil companies do in terms of the environment, you're unbelievably good. You flare less than all the majors. No credit for it. Again, I don't understand.
Well, we care about the environment. In fact, today we're telling investors a lot about what we're doing on ESG, and not just on climate, on water, on governance, on society and the communities where we operate. But we've always operated this way. This is part of the ethos of our company, and we provide reliable, affordable, and ever cleaner energy in a responsible way to a world that needs more and more of it.
How about sequestration? Why not put money into it?
Well, we have. We've put over $1 billion into it, the largest carbon capture and sequestration project in the history of the planet is in Australia, and we built it, we operate it, we're sequestering 4 million tons a year.
I know it is big, I know, but how about here? How about visibility? How about going on exchange and buying credits? How about planting, as Mark Benioff, whom you know well, how about planting 100 million trees?
Yeah.
Pie in the sky?
Trees are good, everybody loves trees. Trees are good for the environment, and look, we're doing things across the board. We're investing in companies that are developing new technologies that can change the game on these things. Direct air carbon capture, or the air in this room, to reduce CO2. So we're investing in technologies, all of which over time are going to be part of the solution.
Do you think younger investors would ever own a oil company, or is it the new tobacco?
No, it's not the new tobacco, Jim. There's big differences. Demand for our product is growing. The U.S. energy economy has never been, the U.S. energy economy and jobs have never been bigger. The trade impact has never been better. It touches every aspect of life. And we're part of today's energy system, and we welcome the energy system of the future, which will be a lower carbon system, and we'll be part of that.
In 1978, Jimmy Carter said the same thing about coal, and it turned out to be a wasting asset. How do we know that oil isn't a wasting asset?
Look, the demand for energy is growing. The demand for all types of energy is growing. The demand for coal has not actually gone down. The demand for coal is still globally as large as it's ever been.
But, look, I struggle. Best balance sheet, best dividend, best everything. And yet, I still don't know. I recommended Chevron for years, Mike. I've been recommending Chevron for 30 years. I stopped. And I stopped because I felt I couldn't make any money for people, because I felt that the tide has turned. Not because you're not doing a great job. You've done a remarkable job. But the industry just, money managers won't buy it.
Look, we're investing in reducing the carbon footprint of our own business. We're bringing renewables into our business. We will later this year feed biofuels into our refinery at our FCC, the first company to ever do that. Renewable natural gas with dairy farmers in California. And we're investing in technology to change the equation. I think investors will see all of these things as we become a part of the energy future that's a lower carbon future.
How about making a pledge that says this is what we must do as oil companies with flaring? I've looked at the chart. You've looked at the chart. There are companies that are flaring, major companies, Mike, that I know you would never stand for. How do you, in an industry that has got the blessing of anything goes from an EPA and a president, how can you establish a standard that is so much better than what the industry currently has?
Well, I think the whole industry needs to address flaring and methane emissions, and we work within the industry, and I see serious companies making real efforts to reduce flaring. Absolutely.
Now, how about just, you mentioned demand, how about on the supply side? Can OPEC help? There's a meeting coming up, or is it just doesn't matter? Because as soon as OPEC tightens, the next thing that happens is the Permian goes nuts again.
Well, I think OPEC has actually had a lot of success in recent years, right. OPEC plus other countries, and we'll see how the meeting goes this week. Clearly, demand is off with concerns about the coronavirus, and I look forward to seeing what comes out of the meeting. There seems to be a lot of optimistic talk that we're hearing this week about further cuts.
All right, let's talk about some things that are going with you. Free cash flow, JP Morgan says, fell a little short. Your CFO agreed with it for the last quarter. You've had some gigantic write-downs. The write-down in Marcellus was very difficult. Atlas turned out to be maybe somebody got had there, so to speak. Some very big overruns and some mega projects. In the end, you work in a business where it's hard to predict, given the fact that you have some misses as well as hits.
Well, so we've made choices on capital, right. And the Marcellus decision really was a decision to no longer fund that dry gas development in the U.S. because we have better choices within our portfolio. So capital discipline is something that we are very committed to, and that means you don't invest in everything that you have in your portfolio. You only invest in the strongest return opportunities, and Permian certainly is one of those. And dry gas in the Marcellus simply doesn't work for us, as well as other things that we've already captured.
Now, what are you going to do about the fact that the long curve just really did drop? That finally we're now looking at 48 out, 5 years. I mean, when I look at 40 out of 5 years, I say, why should I buy Chevron if it looks like the futures tell me that there's no increase over time?
Well, look, what we're committing to our shareholders today is that at flat nominal prices, not even inflation up, we will double free cash flow per share over the next 5 years. We'll have the capacity to return $75 to $80 billion to shareholders through both share repurchases and dividend increases, averaging between 5 and 9% over that period of time, on top of a dividend that's yielding over 5% right now. We're built for a low price environment. We'll deliver to investors in a low price environment.
Okay, well, you may not want to hear this, but I say if you want to own an oil company, of which I say it's too hard right now, I know you want to buy Chevron because it has all those great characteristics and it cares about ESG. But maybe you just think you can't lower the footprint because you're a carbon producer.
Well, I think investors can count on us in the short term and in the long term to do the right thing.
Mike Wirth, Chairman CEO of Chevron. Thank you so much, Mike.
Jim, thank you.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.